If you can go ahead and start the recording, we'll get started. All right, so season of change, April 2023 market update. So we're going to start with some disclosures there as far as just disclosing everything. Give you a second to read those. Okay, so let's talk about how the markets are doing. We want to jump straight in to the major indexes. So far, 2023 has been a pretty good year. We've seen a lot of recovery from 2022. We know that the markets were down, or S&P was down 18% last year. And so we've seen some good recovery. Still a ways to go, but we're seeing some good positive growth thus far. But there might be some headwinds in the near future that we need to be paying attention to. So you can see the S&P's up just over 8% year to date. Now, these are as of market close from April 27th. So yesterday's market close. So April's usually a good month for the markets, but it's been a little shaky with everything going on as far as interest rates and inflation and all of that. But yesterday was a tremendous growth day. Major companies, a lot of the growth tech companies, released their earnings, and many of them beat their expectations. Amazon and Microsoft, a lot of these companies came back with strong first quarter numbers. So that's great to see. But when it comes to interest rates, inflation, that's not necessarily what the Fed wants to see going on right now. So Dow Jones was up 2%. It had a very strong April. That was the best performing index here in the month of April. And the NASDAQ, this has been leading the leading indices so far, up 16%. But again, the NASDAQ was down around 38% last year. So still a lot more recovery needed, and it's remained pretty flat for the month of April. I want to touch on these FANG stocks. We're all familiar with them, with the Facebook, Apple, Amazon, Netflix, Google. Also want to throw in three other stocks. We have Microsoft, NVIDIA, and Tesla. These stocks, was that 8 stocks, have comprised the majority of the growth in a lot of these indices. And so this chart is looking at, with the remaining 492 companies of the S&P 500, what have they done if we take out those FANG stocks? And so this chart is comparing the 492 remaining companies to 3 to 6 month treasury notes or treasury bills. So almost basically like cash. And so you'll see here from this chart that cash has returned around 1.29% from here until this chart goes to April 17th, I believe. Whereas the remaining 492 companies in the S&P 500 have only returned 1.24%. Right, so when we go back to the previous slide and say, okay, the S&P is up 8.2%, and we see that most of the companies are just marginally up. Their stock market recovery is being very much led by these technology stocks. So we see a lot of volatility because a lot of these stocks were down a lot last year as well. So just something to be aware of. This is, if you were on Gage's market update for March, he talked about this being the golden era for fixed income. And we're starting to see some of that. If you're getting outperformance in some safer positions and more cash type positions, then that's pretty remarkable. We don't expect to see that for the long run, but we are in a unique environment right now with that going on. And we've seen that, right, with the Fed's increasing interest rates. When we look at the 13-week treasury yields and the 10-year treasury yields, typically the longer that you keep your money in a treasury or some type of fixed income position, you expect to get a higher yield. That's not the case right now. We're actually seeing these shorter term products returning a higher yield than the longer term. So you can see those numbers here as far as where the rates are. One thing here is mortgage rates. They still are remaining extremely high. We'll get into some housing discussion in just a little bit, but I want to focus primarily on what we call, or what's called, an inverted yield curve. And that's what we're seeing right here with a shorter term 13-week yield paying higher rates than a 10-year Treasury yield. So this chart comes from the Federal Reserve. So the top chart here is looking at a 10-year yield versus a 2-year yield. Now, typically, you'll expect the line to be higher, right, on the 10-year yield. You'd expect to receive a higher yield for a 10-year than the 2-year. And you'll notice that there's times where the line drops below parity or below the even, where they're even. And we're in this type of environment right now. And we've been in an inverted yield curve since July of 2022. So we're coming up on close to a year of these shorter term products or the shorter term fixed income positions paying out a higher yield. And so right now the inversion is at around 0.46 for that 10 and 2-year spread. That's great, but there's also a 10-year comparing it to a 3-month Treasury. And we'll notice that that has an even larger inversion of 1.72. That is the largest spread that we've experienced with this 10 to 3-year in over 15 plus years. So we've also been in this inverted yield for over a year. And you'll notice, now this isn't a guarantee, it doesn't always happen, but many times an inverted yield curve is a signaler for an upcoming or pending recession. And it's not necessarily when it inverts that's the real cause for worry. It's when we start to see that inversion get back to that normal range. With statistics and analysis that's been done on this, when it inverts, that usually signifies that a recession is close to that'll happen probably within like the next 18 months. But when we start to see that inversion normalize, that signifies that the recession is typically much closer, usually within 10 months or so, based off of these different analysis and studies that have happened with these inverted yield curves. And it's pretty remarkable. It's something that we keep an eye on and follow on a regular basis. Now, inverted yield curves are good for short-term investing, but it impacts many other industries. The housing industry is being impacted pretty significantly right now. Home prices fell around 3.3% in March. That's a pretty significant drop because that's the biggest annual drop in over a decade. And we're noticing that certain areas, right, the areas that had the largest growth within the last year or so after the COVID, we're starting to see those cities are being hit the hardest as far as their home prices. So places like Boise, Idaho, home prices and home values have dropped over 15%. Austin, Texas, all you people in Austin, Texas that are on the call, our Austin office, I'm sure you guys have seen this, right? Home values dropping over 13%. And Sacramento, California, over 11, almost 12%. We're also seeing a drop in home sales, right? With interest rates being as high as they are, or mortgage rates being as high as they are, we're starting to see less buyers. More potential sellers are deciding to stay put where they are because they're already in a lower interest rate mortgage, so they're not paying as much. And so interest rates relatively high are causing, sellers or potential sellers to stay put. So when people aren't selling and you're looking for people to buy, we know that there's a housing shortage here in the US. So that's kind of a double-edged sword there, is we're still low on inventory. And so the people that are in essence forced to move are now still getting into bidding wars, right? We saw that a lot in Austin and all these other cities post-COVID, within that 1-2 year period. But now we're starting to see a little bit more of that in places like Milwaukee, Wisconsin, El Paso, Texas, and Omaha, Nebraska, where home values have actually increased. So it's important to pay attention to because many times housing is a good indicator of the overall markets and a leading indicator to possible recessions as well. But with the amount of homes that are available for sale, we're still short on inventory. So for the most part, we're still going to see home prices remain, I would say, probably relative steady for a while until we get that supply and demand a little bit more in line with each other, but we are seeing some differences between different cities there. So that's really all I want to touch on the markets. I wanted to spend the majority of the time talking about change. All right, so there's a lot of good, positive changes that are happening, and we wanted to make you all aware of those changes that will be happening within the next couple weeks and in the next couple months. Okay, so as many of you are familiar, this is how you are currently set up. All right, Oxford Wealth Advisors, we're the advisors. We do all the client facing, your planning, reviewing with you, and anything that you need help with, we're the company and people that you go to and that you're familiar with. Okay, we have our current registered investment advisory firm was Town Square Capital. Okay, so as the registered investment advisory firm, they took care of the compliance, our operational support, our investment manager relationships, and all the trading that would happen within your accounts. Okay. And then we have this Charles Schwab TD Ameritrade. That's where your money's custodian. They're holding onto the money, and that's where you'll receive your statements from. Now, these changes that I'm going to be talking about will only impact our managed accounts. So if you have an account at Charles Schwab, TD Ameritrade, or even our nationwide Jefferson National accounts, there will be some changes, and we'll go on to explain those changes, and we'll open it up to any questions as well. If there's any questions, because change is always a little scary, but we'll tell you how this could impact you. So here's the new way. Town Square was recently purchased by a company called Orion. Now, Orion's a large money management firm, financial tech side of things. They're a very large company. And so once Town Square was bought by Orion, we were now kind of directly dealing with Orion. Now, that created a conflict of interest because Orion has other registered investment advisory firms that they work with. And so to get rid of that conflict of interest, a new registered investment advisory firm was formed. Okay. Now, this advisory firm was formed by employees from Town Square Capital. Okay, so Town Square is sending some of their employees, their key employees, to create Portside Wealth Group. This will allow us to still maintain the accounts exactly like they are. Okay, so Portside's Wealth Group, nothing will change with Oxford Wealth Advisors. Portside Wealth Group will now take care of our compliance and our operational support. More so with the Oxford Wealth side. Doesn't impact you as account holders. And we're still utilizing Town Square for our investments and trading. So nothing is changing in that regard. Now, the other thing that we're going to notice, a change in the near future, is TD Ameritrade and Charles Schwab have merged. They've joined forces, and all TD Ameritrade accounts are going to be merged with Charles Schwab Labor Day weekend this year. Okay, so all of you that have accounts at TD Ameritrade, come September of this year, they will all be switched over to Charles Schwab. This change will impact you more significantly than the registered investment advisory firm change. Okay, so what does that mean? How does this impact you and your accounts? So the RIA change, that side of things, does not impact your accounts, other than you're going to start seeing Portside Wealth on your statements rather than Town Square Capital. That's really it, right? There's not going to be a fee change. There's no investment or strategy change. And with the RIA change, there's no account number or a custodian change. Accounts will stay as they are for the time being. Now, you'll see this because this change is in process. You should be receiving emails, if you have not already, with negative consent, just saying Oxford Wealth Advisors has joined with Portside Wealth Group to become the new registered investment advisory firm. Okay, so on the administrative side, the only change that we're really going to see, it really just impacts us as far as who we are submitting our paperwork to. Okay. So Portside will oversee the managed business, all the administrative and all that. Town Square is going to continue the investment side, but instead of dealing directly through Orion, we had to create that new registered investment advisory firm. As far as the custodian change that's happening in September, how does this impact your accounts? Get ready, because this one will be fun. So all of you that have accounts at TD Ameritrade, you're going to have some big changes, right? Labor Day weekend, we're going to see all of these TD Ameritrade accounts merge over to Schwab. What does that mean for you and your accounts? As far as the investment strategy, fee structure, all of that remains unchanged. Nothing will change there. However, you're going to have a new custodian. Okay, so that means your statements will now be sent from Schwab. And with the new custodian, you will also be assigned a new account number. Okay. Schwab has a different structure for account numbers. It's an 8-digit number instead of 9 for TD Ameritrade. So you will be receiving new account numbers. And if you're currently utilizing Advisor Client, that will be switched over as well. You will have to create a new client login under your Schwab account. So there'll be a lot of change that you will have to do once this change happens. There's nothing, this is all out of our control. There's nothing that we could have done to stop this change. And regardless, this RIA change that's going on right now, at the same time, that has no impact on this custodial change. The custodial change would have happened no matter what. You know, we always say that things just happen in numbers, in large numbers, right? So that change is happening. We're seeing that RIA change and also the custodian change. So be aware. You know, we've been told by Schwab and TD Ameritrade that all information as far as beneficiaries, if you're receiving monthly distributions or making monthly contributions, all of that information should automatically transfer over to the Schwab account. Now, we've been through this before, so as nice as it sounds and as easy as they're trying to make it sound, I'm sure there's going to be some hiccups. But we're here to help you along through that process. And we'll be running reports on our side to make sure, you know, all beneficiaries transfer over, those systematic monthly contributions or distributions are set up properly. So we'll be doing a lot on our end during this transition to make sure that it all just goes as smooth as possible. Here's the thing though, Oxford Wealth is the constant. Nothing with Oxford Wealth is changing. We are going to remain the client facing. Any questions that you have, let us know. We're going to keep it relatively short because I was planning just to open it up. I'm sure there's some questions that could be asked, and I just wanted to open it up at this time to ask any questions or concerns that you all may have.
Hey, Brandon, it's Robert Driscoll. Can you hear me?
Yeah, I can hear you, Robert.